In today's lecture, we will work on calculating depreciation for capital budgeting. Our first goal is to understand the role depreciation plays in project cash flows. Essentially, it is an expense, but it's a non-cash expense. So when we deduct depreciation, we're essentially reducing our tax burden. So it only increases cash flow. We're going to work on understanding the concept of depreciable basis, and we'll look at the two different types of depreciation. There's straight line depreciation and the more real-life based depreciation called MACRS, which stands for Modified Accelerated Cost Recovery System. And of course, at the end, we'll try to figure out what is the value of depreciation for a project. So essentially, depreciation is the way we write off the use of a fixed asset. When we purchase plant, property, or equipment, the IRS will not let us deduct its expense immediately on our income statement. We have to deduct its use over its life. So essentially, we write off the expense through depreciation, and we do it over multiple years. Now, how quickly we deduct an asset depends on the type of depreciation we use and how the IRS defines the asset. Simple straight-line depreciation is found as follows. You take the depreciable basis minus the salvage value divided by the useful life. It is the same amount of depreciation every year. For finance, we're trying to maximize cash flow. So we're trying to maximize the tax benefits from owning an asset. So we want depreciation to be as large as possible. Our approach here with straight line is to always assume the salvage value equals 0. So that reduces our depreciation calculation to just simply the depreciable basis divided by the useful life. Now, why can we do this? Well, in your first accounting class, you've mainly focused on financial statement reporting. Now, a firm keeps two sets of books, one for financial statements and one for tax purposes. For financial statements, firms try to be consistent as possible for transparency of their earnings. For tax purposes, we're trying to save as much money as possible and maximize cash flow. Here's a simple example of straight line depreciation. If we purchase a piece of equipment for $100,000 today and straight line depreciate it to 0 for 5 years, here's the calculation. We take the depreciable basis of $100,000, divide by the useful life of 5 years, and we'd come up with depreciation of $20,000 per year. How do I get the depreciable basis? It's essentially the cost of the equipment plus any installation and delivery costs. So basically, it's just the amount of money I spend to get the piece of equipment ready to manufacture. In a real-life situation, firms typically don't use straight-line depreciation. We use some accelerated form of depreciation, which helps us for our taxes. Because from a time value of money perspective, the greater the depreciation today, the greater the value to me because I get my money sooner. It's the old dollar today is better than a dollar tomorrow idea. A standard accelerated depreciation method used by firms is called MACRS, or Modified Accelerated Cost Recovery System. Now, how you apply MACRS is governed by the IRS. When you purchase an asset, it falls into a certain class or category which is defined by IRS forms and schedules. For example, there's a 3-year MACRS schedule, a 5-year, a 7-year, a 10-year, a 20-year, a 30-year. It really depends on what you're buying. If I were to buy a computer or a laptop today, typically that would fall under a 3-year MACRS schedule. Something more long-lasting, like an assembly line or a work cell, might have a 20-year MACRS schedule. The point is, the IRS defines the period that I depreciate the asset. MACRS is relatively straightforward to calculate. You simply take the allowed percentage each year by the IRS and multiply by the depreciable basis. This is the same calculation every time. The only thing that changes is the allowed percentage, and that is given to you by the IRS on the MACRS table. You always multiply by the depreciable basis. A common mistake finance students make is they treat this like double declining balance from accounting, and they try to multiply by the book value. That's not what we're doing here. It's always by the depreciable basis. Here's an example. A firm buys the same computer for $100,000. The IRS will let us depreciate it using a 3-year MACRS schedule. Find the yearly depreciation for this asset. Now, common question that comes up in my on-campus classes, do we have to memorize these makers' schedules? And the answer is no. For testing purposes, I will always give you a schedule for the asset that's represented in a problem. So don't worry about this. Let's just worry about the methodology. So for a 3-year maker's schedule, you get 4 years of depreciation. And if you look at the percentages, they add up to 100%. And notice, of course, they're not the same every year. Looking at this example, we apply the allowed rate times the 100,000 each time, and that gives us our yearly depreciation. And of course, notice it adds up to 100,000. The question you're asking is probably, why do I get 4 years on a 3-year maker schedule? Well, the logic is this. The IRS assumes that you don't buy the equipment on January 1st and start manufacturing that day. They assume equipment purchases happen throughout the year, so for the first year, they just take an average and give you half a year depreciation for year 1. Then they give you an extra year on the end to recapture that lost depreciation from year 1.